Welcome to ZZ Financial. We're dedicated to providing the most accurate, valuable, and timely information and analysis.
Now, it's late night, 10 p.m. Eastern Time, 7 p.m. Pacific, on Thursday, August 21st. The financial world always seems to be buzzing, but gosh, today it feels like we're grappling with a really fascinating mix of signals from all over the globe, from courted boardrooms to whispers about central bank speeches. There's just so much happening. And I'm really looking forward to unpacking what it all means for us, for our investments, and, well, the bigger economic picture.
Absolutely. Sometimes the daily news can feel like just a flood of headlines, right? Each one pulling you in a different direction. So our mission today is to untangle that complex web. We're talking corporate earnings, big market shifts, a whole host of macroeconomic indicators. And as we delve in, you'll see how all of this is really deeply influenced by major upcoming events like Jackson Hole and crucial policy decisions. We're going to connect those dots for you, help you see the bigger picture, understand not just what happened, but why it matters and, what ripples it might send out.
Okay, let's dive right in then. This first piece of news, it genuinely caught my eye straight away. McDonald's stock took a bit of a dip, and it's all because of, wait for it, their one-piece Happy Meals. That sounds almost made up, but it clearly had a real impact. What exactly happened there? What went wrong?
It does sound a bit counterintuitive, doesn't it?
Yeah.
Especially for a huge brand like McDonald's. But it's a very real and actually quite interesting situation. It really shows how even seemingly minor operational choices can have these pretty big market and brand implications. So McDonald's announced it was halting sales of its one-piece Happy Meal. These included popular manga cards as a bonus, you see, and they halted it before its scheduled launch on August 29th.
Before it even started.
Exactly. This preemptive halt immediately led to a 1.05% stock drop for the company, down to 6,580 yen.
Wow, so they pulled the plug early and the market just reacted instantly. Was this like a one-off thing, or has McDonald's dealt with this kind of collectible chaos before?
Yeah. Unfortunately, this isn't exactly a new headache for them. They've run into very similar problems with previous promotions. Remember the Pocket Monsters, Pokemon Happy Meals?
Oh, right. I vaguely remember something about that.
Same kind of issue. The core problem here, and this really gets to their brand integrity, was just widespread bulk buying for resale. People were literally buying these meals just for the collectible prizes.
Not even for the food.
Often, no, which then led to them discarding the food. Imagine seeing videos online, perfectly good food being thrown away, or these coveted toys being scalped for crazy prices on secondary markets.
Ooh, yeah, that's not a good look.
Not at all. It's not just a logistical nightmare for McDonald's. It's a serious public relations problem. It completely undermines their whole family-friendly, value-driven image.
I can absolutely see that. It just cuts right against their brand message. So, okay, it caused a short-term stock dip, but was this decision actually maybe a smart move for McDonald's in the long run? It sounded like they took a hit to protect their reputation.
Precisely. You've hit the nail on the head. Analysts, like Taku Sugawara of Cosmos Securities, they highlighted this deterioration of brand image as a major concern. It's never good to see food wasted or products being scalped, especially for a company like McDonald's that really prides itself on being accessible, community-oriented. However, and this is where the deeper insight lies, this decision, while causing that immediate stock dip, is widely seen as a potential good opportunity for improving brand image in the medium to long term.
Interesting. So a calculated sacrifice almost.
Kind of, by proactively reviewing their sales methods and, setting up new, stricter rules. McDonald's is showing that they're willing to sacrifice short-term gains or maybe avoid short-term pain to protect their fundamental reputation and values. For any business, really, this shows the unexpected power of cultural things like popular manga cards to accidentally create a brand crisis. It forces a short-term financial hit that, hopefully for them, strengthens long-term brand equity through a very public show of ethical commitment.
That's a wild story. And yeah, powerful lesson in looking beyond just the immediate numbers to the strategy behind it. But while some companies are fighting these kinds of internal battles, others, like Walmart, seem to be navigating huge external forces. I saw their stock fell, but their sales actually grew. That sounds like a complete contradiction. Isn't revenue growth always a good thing? Like unequivocally good?
It absolutely sounds like a contradiction, and it's a fantastic example of why we, as, informed observers, really need to look beyond just the headline number or the top-line figure. So on the surface, yes, Walmart stock fell 5.4%, down to $96.95. This happened despite a very strong 5% increase in their Q2 fiscal 2025 sales. They soared to $177.402 billion, actually beating analysts' forecasts.
Okay. Beating forecasts, sales up, stock down.
Exactly. So top-line sales grew significantly, which normally, yes, signals strong performance.
So what was the catch then? If sales were beating expectations, what on earth could make the stock drop that much? Was it guidance or something else?
The catch was hiding in the earnings per share, the EPS. Their EPS, if you exclude special items, came in at $0.68. That missed the market expectation of $0.73.
Oh, okay. The profit miss.
Precisely. And the culprit, as management explicitly stated, was tariffs. Specifically, the Trump administration's tariff hikes. They actually reported that costs are increasing almost every week for inventory replenishment because of these tariffs.
Every week, wow.
Yeah. And they expect this trend to continue for at least 2 more quarters. Imagine the constant recalculations for a giant like Walmart with thousands and thousands of suppliers. These tariffs translate directly into higher costs to get goods on the shelves, and that squeezes their profit margins.
Okay, so the increased costs from tariffs were just eating away at their profits, even though people were buying more stuff. That makes perfect sense now. So how did Walmart respond? Did they just pass those costs on? Because raising prices feels like it goes against their whole identity.
That's where their strategy, their strategic thinking comes in. To maintain that low-price competitiveness, which is their core identity, right? It's their big advantage, especially when household budgets might be tightening. Walmart actually increased the number of discounted items by about 2,000 in Q2. That brought the total to roughly 7,400 items.
So they discounted more things.
Yes. They chose to absorb a significant chunk of that tariff impact internally. They sacrificed some profit margin to keep prices low for the customer. This, of course, led directly to that EPS miss that spooked the market.
Got it.
Some analysts, like Matthew Mahatali over at Miller Tabak, suggest that this might even indicate a broader shift in consumer behavior. Maybe middle-income earners are shifting towards Walmart's low-price strategy, signaling potential weakness in spending at other, maybe higher-priced retail segments.
That's a really smart move, though. Aggressive, maybe, but smart. They basically sacrifice profit to hold on to their price leadership, maybe even gain market share during a tough time. So, despite the stock drop, is Walmart still seen as fundamentally strong? Or could this strategy backfire if tariffs stick around or get worse?
That's a very perceptive question, thinking about the sustainability, right?
Right.
Well, while it definitely squeezed profits, Walmart actually raised its full-year sales outlook.
Oh, it did?
Yes. And maybe even more telling, its e-commerce sales accelerated to a phenomenal 26% growth.
26%.
Huge. This demonstrates really powerful underlying performance and a clear strategic advantage in what is a challenging economic environment. Their CEO, Doug McMillon, specifically noted that the growth in e-commerce and also their advertising business, quote, increases flexibility in absorbing some tariff costs, meaning these higher margin parts of the business give them some breathing room.
Okay, so other parts of the business are helping offset the tariff pain.
Exactly. And if you compare this to competitors, look at Target, for example. They saw a 1.9% decline in same-store sales, and they even had a CEO change recently. So Walmart's performance, even with the profit challenges, looks remarkably robust, especially in general merchandise.
Right. Relatively speaking.
Absolutely. Analysts from places like Mizuho Securities, for instance, view Walmart as a must-own stock in consumer-related shares. Why? Because of its resilience to consumption downturns and the fact that its e-commerce business seems to be hitting a turning point in profitability. They even suggested buying on dips during these stock declines, seeing them as opportunities.
Interesting perspective.
It just highlights so clearly how policy, like tariffs, directly impacts corporate financials, but also how resilient, well-run companies adapt, even if it means taking some short-term pain for that longer-term strategic advantage.
That's a super clear example of external factors hitting companies. But what about internal problems? Things going wrong inside the company itself. I saw a headline about W.H. Smith, the UK retailer, the one in airports and train stations, taking a huge hit because of some accounting issues. That sounds not just serious, but potentially devastating for investor trust.
Oh, it is extremely serious.
Yeah.
And devastating is exactly the right word for the impact it had on investor confidence. W.O. Smith's shares fell. Get this, a staggering 42% after they revealed accounting irregularities in their North American business.
42%? Wow, that's almost half their value wiped out. What exactly happened? What does irregularities mean here? Was it fraud or an error?
The core issues stemmed from something called premature revenue recognition from suppliers.
Okay. What does that mean in plain English?
In simpler terms, they were essentially booking revenue from certain suppliers too early, before the conditions for actually recognizing that revenue, under accounting rules, were fully met. This mistake led to an overestimation of their North American operating profit by about £5 million.
So they thought they made £5 million more profit than they actually did.
In that division, yes, which meant they then had to revise it down to $25 million for fiscal year 2025. And this, naturally, cascaded down. It reduced their overall pre-tax profit projection for the whole company to £110 million. That was well below what the market was expecting, which was around $140 million.
So they were basically telling the market they were making significantly more money than they actually were, even if it was, maybe an error rather than deliberate fraud. That explains why investor confidence would just evaporate. If you can't trust the numbers they're putting out, how can you invest?
Precisely. It fundamentally undermines investor confidence because it calls into question the reliability of all their financial reporting, not just this one number. And this is particularly damaging because North America is seen as a crucial growth market for W.H. Smith. They have ambitious plans to add 70 stores there in the next 3 years.
Right, so investors were banking on that growth story.
Exactly. And suddenly the foundation of that story felt shaky. Investors were betting on that growth, and now the numbers look unreliable. And while their overall first-half fiscal 2025 sales did grow 3% to $951 million, they also reported a pre-tax loss of £42 million.
A loss. Wow.
Yeah, compared to a profit last year. Now, that was mainly due to impairments, write-downs in their UK business. But this accounting misstep in North America just compounded the existing issues. It created a perfect storm for the stock.
What a mess.
It really highlights the critical absolute importance of transparent and accurate financial reporting. Even what might seem like a single accounting error, if it's in a crucial growth segment, can just devastate investor trust and market value. Why? Because it makes all their future guidance and indeed the entire financial picture they present suspect. It's a really stark reminder that in finance, trust is, well, it's the ultimate currency.
Okay, so from the world of retail and accounting woes, let's jump over to big tech. Baidu, the Chinese internet giant. They had a rather mixed bag in their latest earnings report, didn't they? Their traditional core business advertising seemed to struggle, but AI looks like it's picking up the slack. How significant is this shift for a company of Baidu's huge scale? And what does it tell us about the future of tech, maybe?
You've hit on a key point. It was definitely a mixed bag. And for a company of Baidu's stature, this shift is incredibly significant. It's almost like a blueprint for how other legacy tech giants might need to adapt. So Baidu's stock fell in Hong Kong after reporting that its Q2 2025 revenue dropped 4% year-on-year, coming in at RMB 32.713 billion. Their core online advertising business, which has historically been their main engine, actually declined by a substantial 15% to RMB 16.2 billion.
15%. That's a big drop for a core business.
It is. And even iQIYI, their video streaming subsidiary, saw an 11% drop in revenue. So the traditional segments are clearly under pressure. They're facing, mature market dynamics, maybe increased competition.
Okay, so a pretty clear decline in their established traditional areas. But you mentioned AI picking up the slack. How exactly is that happening? And how can declining revenue still lead to a positive outlook, or at least a mixed one?
That's the really interesting part, the silver lining and the crucial strategic pivot they seem to be making. Their non-advertising businesses, which are crucially driven by AI and cloud services, actually exceeded RMB 10 billion for the first time ever.
10 billion RMB from non-advertising. That sounds like a big milestone.
It's a monumental milestone for them. And here's where it gets really interesting. Despite the overall revenue decline, their net profit actually increased by a robust 33% year-on-year.
Wait, revenue down 4%, profit up 33%? How does that work?
It works through cost efficiencies, certainly. But more importantly, it points to the high-margin nature of their growing AI segments. Think of it like this. If you're shifting from selling maybe a lower-margin, high-volume product like traditional online ads to a higher-margin, specialized service like sophisticated AI cloud solutions, you might actually need less total revenue to generate more bottom-line profit.
Okay. So AI is just much more profitable per dollar of revenue for them.
It seems that way. AI is increasingly becoming that high-margin service for companies like Baidu.
That's a powerful combination, then declining overall sales but rising profit, all thanks to this AI push. What are they planning next with this newfound AI strength? You mentioned autonomous driving earlier. Are they doubling down there?
Their future focus is unequivocally on AI. Baidu CFO, He emphasized continued aggressive investment in AI research and development. and perhaps even more notably, accelerating the global expansion of their autonomous taxi business.
Global expansion, so taking it beyond China.
That seems to be the plan. This isn't just some minor adjustment for them. It feels like a fundamental pivot. It's a blueprint, really, for adaptation. It shows how a major tech company can actively navigate a challenging transition, strategically offsetting declines in its traditional, maybe maturing segments with growth in these cutting-edge, high-potential areas like AI and autonomous driving. It just illustrates how rapidly the tech landscape is evolving and the absolute necessity for even these established giants to innovate relentlessly or, risk being left behind. They are clearly banking on AI being the next big driver of revenue and profit.
Speaking of AI, there's another company, CoreWeave, that saw a big jump recently. They're all about AI cloud infrastructure, right? What's
Yeah.
making them stand out? Because that field feels incredibly crowded all of a sudden. There are so many players trying to get into AI infrastructure.
CoreWeave is indeed a fascinating example. They're a specialized player making significant inroads in a very competitive, very rapidly expanding sector. Their stock actually rose 4.7%, temporarily hitting $95.84. This was driven by an analyst upgrade to buy from H.C. Wainwright, and also the news that a major investment firm, Jane Street, had acquired a substantial 5.4% stake.
Okay, so external validation from analysts and big institutional money getting involved, that's usually a good sign. But what's their edge? What's their secret sauce in the AI cloud space that gives them an advantage over, say, the huge players like Amazon Web Services or Microsoft Azure?
Well, H.C. Wainwright lauded CoreWeave as a pioneer in the adoption of one of the most impactful technologies of this era. High praise. But their real competitive strength, and this is truly critical, is their capital and business partnership with NVIDIA.
NVIDIA, the king of AI chips.
Exactly. This collaboration gives them early, often preferential, access to NVIDIA's newest, most cutting-edge AI products, their GPUs. In the world of AI, where hardware innovation is just moving at lightning speed, having that first-mover advantage and maybe even guaranteed supply is a massive differentiator.
That makes sense. Access to the best tools first.
Right. The analyst also directly challenged some prevailing research out there, suggesting AI adoption isn't always beneficial for companies. They asserted that, quote, AI adoption is essential across all business areas to maintain competitiveness. This really highlights their conviction that CoreWeave isn't just providing some luxury service, but something fundamental, a necessity for businesses looking to stay relevant in this digital age.
So they're positioning themselves not just as a service provider, but as a fundamental part of the future business landscape. Almost like a utility for AI. But didn't they also report expanded losses in Q2? And I think their lockup period expired for early investors, which often means selling pressure. So why is the market still seemingly so bullish? Why set a price target way up at $180?
That's a great question, and it really speaks to the long-term vision that investors seem to have for CoreWeave. Despite those expanded losses in Q2, which frankly is pretty common for high-growth tech companies aggressively investing in building out infrastructure, and despite the recent expiration of that lockup period, which typically does trigger a wave of selling from early investors and insiders,
Right.
the market clearly sees significant long-term potential here. The analysts set that $180 target, seeing the stock's recent 20% fall since August, after its initial post-IPO highs, as actually a buying opportunity due to the now lower valuation.
By the dip, basically.
Essentially, yes. CoreWeave illustrates how these specialized players are emerging and gaining serious traction in the absolutely crucial AI infrastructure space. They are, in a way, the pick-and-shovel providers for this massive AI gold rush. Their success validates the enormous investment and the transformative potential that everyone sees in artificial intelligence.
Okay, so AI is definitely a huge driving force, but it seems there are also significant headwinds, especially on the geopolitical front, aren't there? What about this news regarding NVIDIA halting production of an AI chip that was specifically designed for China? That sounds like a really big deal for the whole semiconductor industry, particularly with U.S.-China tensions always sort of simmering in the background.
This is indeed a very big deal, and it's a clear, quite stark illustration of how these geopolitical tensions can directly and immediately disrupt global tech supply chains. It forces companies to drastically alter their strategies. Online media initially reported that NVIDIA instructed its suppliers to halt production of the H20 AI semiconductor.
The H20, wasn't that the chip NVIDIA designed specifically to comply with earlier U.S. export rules for China, like a less powerful version?
Exactly. It was specifically designed for the Chinese market to try and comply with previous U.S. export restrictions on the most advanced AI chips. The report was later corroborated by Bloomberg, which gave it significant weight.
So the H20 was NVIDIA's attempt to navigate those restrictions, a sort of China-compliant chip. And now even that is being halted. That sounds like a major tightening of the screws in the tech trade war. How did the market react, particularly in Asia, where so many chip-related companies are based?
Precisely. It signals a further tightening. The news immediately sparked what traders call reflexive short selling in domestic chip stocks in Tokyo.
Meaning?
Meaning investors quickly bet against those stocks, anticipating further declines. Advantest, for instance, a key semiconductor testing equipment maker in Tokyo, dropped 2.6%. The overarching concern was the renewed impact of U.S.-China trade tensions on the broader semiconductor market conditions. We've seen this movie before, haven't we?
Yeah, feels like it.
Where export controls, licensing requirements, tit-for-tat restrictions, they just create immense uncertainty for companies relying on global supply chains and cross-border sales.
So more evidence of this ongoing tech tug-of-war between the two big economic superpowers. Were all semiconductor stocks hit equally, though? Or was there some nuance in how the market reacted?
Not entirely, which is always interesting to observe during periods of volatility like this. While some stocks definitely fell, others like Tokyo Electron or T-Tel, another big player, actually rebounded after some initial selling.
Huh. Why would that be?
It suggests that even amid the volatility and the geopolitical worries, some investors were perhaps looking for buying opportunities. Maybe they felt the dip was overdone for certain players, or that not all companies would be impacted equally. But the core takeaway is undeniable. This event clearly underscores the ongoing, intense geopolitical complexities that are shaping the global tech supply chain and the whole investment landscape. It's a direct consequence of export and usage restrictions, making it much harder for companies like NVIDIA to plan and execute their strategies, and frankly harder for investors to predict their future earnings with any real confidence.
It feels like so much of what we're discussing today, from these individual company stories to the currency movements, keeps coming back to one big looming event. The Jackson Hole Conference, and specifically Fed Chair Powell's speech there. Why is everyone holding their breath for this particular event? What are they hoping or maybe fearing to hear from him?
You're absolutely right. Jackson Hole is casting a very long, very influential shadow over pretty much all the markets right now. The Jackson Hole Economic Symposium, which is hosted annually by the Kansas City Fed, actually began today, August 21st. Fed Chair Powell's remarks are scheduled for tomorrow, August 22nd. Investors, traders, economists, everyone is keenly awaiting his words for any definitive clues on future monetary policy. Specifically, they're looking for signals about the potential timing and the pace of interest rate cuts. The market is effectively just in a holding pattern until he speaks.
What makes this particular speech so critical, especially right now? Is it just about whether rates will be cut soon, or is there more nuance because the economy itself seems to be sending such mixed signals?
It's entirely about the nuance. And those conflicting data points are precisely what makes this moment so critical and Powell's job so difficult. The U.S. economy, as you said, is sending very mixed signals and is creating a real dilemma for the Fed. On one hand, we've seen surprisingly strong economic data recently. That August manufacturing PMI, the Purchasing Managers Index, came in at 53.3. The services PMI was even stronger at 55.4. Both suggest continued resilience, ongoing economic activity.
Which normally argues against cutting rates, right?
Yeah, exactly. But on the other hand, there are also signs of a softening labor market. We've seen rising unemployment claims, for instance. And while inflation is moderating, it's still proving somewhat persistent.
So tough balancing act.
A very tightrope for Powell to walk. He might just stick to the recent script, the data-dependent stance, suggesting no immediate rush for cuts. The market would likely see that as hawkish, meaning rates stay higher for longer. Alternatively, he might hint, even subtly, at a potential September rate cut, which the market has already partly priced in. But any strong signal either way is going to trigger significant market movements.
So his words could dramatically shift market expectations, and by extension, our portfolios, our retirement accounts, everything. How do investors typically prepare for such a high-stakes moment of uncertainty? Do they just sit on their hands?
Precisely. His words will have a significant influence on investor sentiment, global stock market movements, currency valuations, you name it. Because of this high-stakes anticipation, active trading is quite restrained right now. Many big institutional investors, traders, they're simply waiting for Powell to speak before making their next big move. They might reduce risk, hold more cash.
Let's wait and see.
Pretty much. This is a live demonstration, really, of how central bank communication acts as a primary market mover. Understanding these high-profile events and the potential scenarios Powell might lay out is just crucial for understanding market direction and how to position yourself. It's like everyone is holding their breath before the big announcement, trying to guess which way the wind will blow.
So, with Jackson Hole looming and everyone holding their breath, how are the major currencies reacting? The yen, the dollar, the euro? I'm seeing a lot of movement, especially with the yen. It feels like the dollar is just incredibly strong right now. Is that connected to the Fed expectations?
Indeed, the foreign exchange market is a very dynamic picture right now, heavily influenced by these shifting expectations and that anticipation around Jackson Hole. The yen in particular has been noticeably weakening against the dollar. It fell to the mid 148 yen range earlier, around 148.4041 per dollar.
Why is the yen weakening so much, especially when Japan's inflation, while lower than elsewhere, is still present? Is it all just about the interest rate gap between the US and Japan?
Interest rate differentials are definitely a major factor. Firstly, as we discussed, we have those stronger than expected U.S. economic indicators, the PMIs, home sales. They signal resilience in the U.S. economy. This naturally reduces expectations for aggressive or even imminent Fed rate cuts.
Right. If the economy's strong, why cut?
Exactly. Second, this resilience, coupled with Fed officials like Cleveland Fed President Hammack and Kansas City Fed President Schmidt expressing caution about cutting rates too early, maintains a wider interest rate differential between the U.S. and Japan. Japan's policy rate is still incredibly low, near zero. U.S. rates are much higher, so those higher yields in the U.S. make dollar-denominated assets much more attractive, drawing capital away from the lower-yielding yen. It's essentially a global search for yield.
Ah, the interest rate gap explanation makes sense. I've also heard people talk about something called carry trades involving the yen. Is that related to its weakness? How do those actually work?
Yes, very much related. Demand for yen carry trades is apparently quietly increasing. This is a strategy where investors, often large institutions, borrow low-interest yen. Since Japan's policy rate is below 1%, it's incredibly cheap to borrow yen.
Okay, borrow cheap yen.
To then invest that borrowed capital in higher-yielding assets abroad, often in U.S. dollars or maybe other currencies offering better returns. Imagine a hedge fund borrowing billions of yen at virtually zero cost and then investing that money into, say, U.S. Treasury bonds, paying 4% or more. They pocket the difference, the carry.
As long as the exchange rate doesn't move against them too much.
Precisely. The relatively stable forex volatility, recently, 1-month implied volatility is around 9%, reduces the perceived risk of a sudden, sharp yen appreciation, which would wipe out their profits. This stability, combined with orderly monetary policies for now, makes the carry trade strategy quite appealing for investors seeking those higher returns in a low-yield world.
So it sounds like a lot of forces pushing the yen down. Are there any factors that might prevent it from falling even further? Or is it just a one-way bet right now, given these powerful drivers?
Well, it's rarely ever a completely one-way street in Forex. There are always countercurrents, potential pushbacks. There are indeed some limits, or potential limits, to the yen's decline. Firstly, Japan's own July CPI inflation reading, excluding fresh food, came in at 3.1% year-on-year.
Which was higher than expected, right?
Yes, it actually exceeded market expectations of 3.0%. This keeps alive the speculation of potential Bank of Japan or BOJ rate hikes down the line. If the BOJ starts to tighten its monetary policy even gradually, that could provide significant support for the yen, narrowing that interest rate gap.
Okay, so BOJ action is one potential break.
Exactly. Also, just on a technical level, that mid-148 yen range, particularly around 148.40, is seen by many traders as a short-term support level. You might see Japanese retail investors, for instance, who have been betting on dollar strength, start to take profits around this level, which could temporarily slow the yen's depreciation.
Got it. And what about the euro in all of this? How does it fit into this dynamic currency picture between the strong dollar and the weak yen?
The euro generally fell against the dollar, reaching down towards the 1.1610 nel level. That was primarily due to that broad dollar strength we've been discussing, especially after the strong U.S. PMI data came out. However, the euro did see some temporary support from better-than-expected German and French PMI readings earlier. Those eased some concerns about the European economy and perhaps reduced pressure on the European Central Bank to cut rates aggressively.
So a bit of a mixed bag for the euro, too.
Yes, and interestingly, as the yen weakened against the dollar, the euro actually appreciated against the yen. So you get this complex three-way dynamic. It really is a masterclass in how multiple forces, economic data, central bank talk, investor strategies like carry trades, even technical chart levels, all converge and interact to shape these currency movements. It's a constant, intricate global dance.
It really does sound like a complex dance. And where do bonds fit into all this? Bonds often seem a bit, well, dry compared to stocks or currencies. But I'm hearing about rising yields, higher interest rates in the US, in Europe, and even in Japan, despite their very different central bank policies. What story are the bond markets telling us right now?
You're absolutely right. The bond market, while maybe perceived as dry sometimes, is actually telling a very clear, if nuanced, story about global economic expectations right now. In the U.S., long-term bonds fell in price, which pushed the benchmark 10-year Treasury yield up to 4.33%. This was a direct response to that strong U.S. economic data. We keep coming back to the solid PMIs, the decent home sales, and also those cautious statements from Fed officials like Hammack and Schmidt, basically pouring cold water on hopes for immediate rate cuts.
So, stronger economy, less chance of cuts, makes people demand higher interest on long-term debt.
Precisely. When the economy looks stronger and imminent rate cuts seem less likely, investors demand a higher return, a higher yield, for locking up their money in long-term debt. That causes yields to rise and existing bond prices to fall. Market expectations for a September Fed rate cut actually fell slightly, down to about 73% after these developments.
Okay, that makes sense for the US. What about Europe? Are their bond markets reacting to similar signals, or is it different drivers over there?
A pretty similar story, actually, but driven primarily by their own regional data. German 10-year bond yields rose to the mid-2.7% range. UK 10-year yields pushed up into the early 4.7% range. This was largely driven by those stronger-than-expected August PMI figures coming out of Germany, France, and the UK.
The ones that supported the euro briefly.
Exactly. Those readings ease concerns that the European economy might be heading into a sharp downturn or recession. And when recession fears ease, the demand for safe haven assets like government bonds tends to decrease, which pushes their yields higher. It's the market basically adjusting its expectations for future growth and inflation in Europe.
Okay, so US and Europe seeing yields rise on signs of economic resilience, but Japan, which has a totally different central bank policy, trying to keep rates near zero, still saw rising bond yields. That seems surprising. How can yields rise there if the Bank of Japan is actively trying to suppress them?
Even Japan, yes. It's quite remarkable. Domestic long-term Japanese government bond, or JGB, interest rates reached a 17-year high of 1.615%. That's the highest they've been since October 2008.
17 years. What's driving that against the BOJ's wishes?
The drivers here are kind of twofold. First, that higher-than-expected July CPI reading in Japan, the 3.1%. It fueled speculation that the Bank of Japan might be forced into an earlier rate hike than previously thought. If inflation persists, the BOJ might have to adjust its ultra-loose monetary policy sooner rather than later.
So domestic inflation pressure.
Right. Second, and importantly, the rise in U.S. Treasury yields inevitably puts upward pressure on Japanese bond yields too, just due to global market interconnectedness. Global capital flows link these markets. If investors can get a much higher yield elsewhere, it puts pressure on JGB yields to rise somewhat to remain competitive, even with BOJ intervention.
Global yield contagion, almost.
You could call it that. Also, there were some technical factors. A recent auction for interest-bearing GGBs was apparently perceived by the market as showing somewhat loose supply and demand, which added a bit to that upward pressure on yields. Now, while a 1.6% yield might start to offer some investment appeal for domestic investors, these supply-demand concerns persist. However, if we see a confirmed slowdown in CPI growth in Japan in the coming months, that could provide some future support for bonds, maybe capping the yield rise.
It sounds like all these individual bond market movements, US, Europe, Japan, might be part of a bigger global trend then, something beyond just country-specific factors.
Absolutely. And what's truly fascinating from a macro perspective is this broader global trend we're seeing, the yield curve steepening.
Okay, the yield curve. I hear that term a lot. Remind us what steepening means again.
Sure. It simply refers to the difference or the spread between long-term bond yields and short-term bond yields getting wider. For example, the U.S. 30-year Treasury yield minus the 2-year Treasury yield spread widened to 1.169%. That's the largest gap we've seen since January 2022. And we're observing similar steepening trends in Germany and Japan as well.
Okay, so the gap between long-term rates and short-term rates is growing. Historically, what does a steepening yield curve usually signal about the economy?
Historically, a steepening yield curve can signal a few things, often pointing towards expectations of stronger economic growth or rising inflation in the future. Short-term rates are often anchored by current central bank policy, while long-term rates reflect market expectations further out.
Why is this happening seemingly everywhere at once? What's driving this global steepening, especially when central banks in different countries have such different policies right now?
There seem to be a couple of key reasons converging to drive this global steepening phenomenon. Firstly, across major economies, we're seeing increasingly expansionary fiscal policies.
Meaning government spending more or taxing less?
Exactly. Think about the U.S. With ongoing discussions about potential tax cuts. Some analysts are even dubbing potential future legislation the one big beautiful bill because of its potential scale. Or look at Germany's large-scale defense spending increases, or Japan's own ambitious fiscal plans. All these suggest increased government borrowing is likely needed down the line. And that means more government bond issuance, especially ultra-long-term bonds, to fund these initiatives. More supply of long-term bonds naturally tends to push their yields up.
Okay, so government spending plans pushing up long-term borrowing costs. What's the second reason?
The second reason is related to economic and inflation expectations. While short-term yields might still be suppressed by central banks, especially if they're in a rate-cutting cycle or, like Japan, keeping rates very low, longer-term yields tend to rise more significantly if the market perceives that the economy and inflation might be bottoming out or heading for an uplift in the future. And these expansionary fiscal policies, pouring government money into the economy, are seen by many as potential growth and price boosters down the line.
So the bond market is maybe looking past the current central bank actions and anticipating future growth and inflation driven by government spending.
That seems to be a big part of the story. The implications are profound. This steepening reflects both potential fiscal risks, governments may be borrowing a lot more, and the market's anticipation of stronger future economic activity and inflation. If this trend of fiscal expansion continues to fuel these perceptions, the steepening trend in yield curves will likely persist. So bonds, often seen as these, dry financial instruments, are actually telling a really compelling forward-looking story right now. It's about economic strength, inflation battles, central bank intentions, and government spending plans all interacting around the world. It's a critical indicator of future economic direction and potential shifts in global capital flows.
So, with all these macroeconomic currents swirling around, Fed expectations, currency moves, steepening yield curves, what does it all mean for stock markets globally? The Nikkei average in Japan, for instance, has been on quite a ride, hitting new highs recently. Are we just seeing a pause after that big run, maybe some profit taking, or is it something more significant brewing there?
It has indeed been quite the roller coaster for the Nikkei, and we are certainly seeing a pause, maybe even a clear pullback, after its recent powerful surge. The Nikkei average did recently hit a new yearly high, briefly touching that 43,000 yen mark. However, the upward momentum has visibly weakened since then. The index has fallen about 1,100 yen from its peak on August 18th. Today, it opened slightly higher but then turned lower, trading around the 42,500 yen level. So yes, the recent exuberance seems to have given way to a bit more caution.
So, a bit of a correction setting in. Is this mainly due to something specific within Japan, like profit taking after the big run, or is it more about general market jitters filtering in from the US or elsewhere?
It really seems to be a combination of factors, and they're signaling some short-term overheating and growing investor caution. The rapid rise to those highs definitely led to some overvaluation concerns. The price-to-book ratio, or PBR, got near 1.6 times. The index was trading about 10% above its 200-day moving average. These are metrics that often suggest a market might be running a bit ahead of itself, technically speaking.
Right, flashing yellow lights.
Exactly. This, coupled with somewhat tepid trading volume, only around 5 trillion yen daily, and a high advanced decline ratio, which measures market breadth, it all indicates that investors are becoming more cautious. The market might have been a bit overheated in the short term, leading naturally to some profit-taking. And crucially, yes, the declines we saw in U.S. stocks, the Dow, the Nasdaq, and especially the SOX semiconductor index also weighed heavily on Japanese markets, particularly their own semiconductor-related stocks like Advantis and Tokyo Electron, just given how globally interconnected these sectors are.
Okay, so a mix of domestic technical factors and global influence. Given this pullback and these signs of overheating, are analysts still generally optimistic about Japanese stocks long term? Or is the outlook turning more bearish? Because we've heard so much talk this year about Japan finally making a sustained comeback.
That's the really fascinating dichotomy playing out. Interestingly, from a medium-term perspective, there still seems to be a strong undercurrent of optimism among many analysts. Mitsunari Akinono, who is the president of Ichiyoshi Asset Management, for example, still sees room to rise for Japanese stocks. He actually projects the Nikkei could reach 48,000 yen within the next 6 months.
48,000, that's quite a leap from here. What's driving that bullish outlook?
It seems to be driven by expectations of a strengthening U.S. economy, perhaps fueled by potential stimulus measures, like those associated with former President Trump if he were to return to office, and, critically, continued strong foreign buying of Japanese equities. He forecast the Topix Index's earnings per share, EPS, could potentially hit 190 yen with a price-to-earnings ratio, PER, of 18 times, suggesting corporate earnings in Japan still have room to grow significantly.
So, foreign investors are still actively buying Japanese stocks, even with the recent volatility and the yen weakening. That seems almost counterintuitive if the currency they're buying with is getting stronger against the yen.
Absolutely, and the data supports it. Despite what's usually considered a quieter summer lull in trading activity, overseas investors actually net bought a massive 1.1617 trillion yen worth of domestic Japanese stocks in the week from August 10th to 16th.
Wow, over a trillion yen in 1 week.
Yes, it's the largest amount since back in March, April. This indicates a really strong treasure-hunting mentality among foreign investors. They seem to be looking for undervalued Japanese stocks with a medium to long-term perspective, looking past the day-to-day fluctuations.
So they see long-term value despite the short-term noise.
That appears to be the case. We even saw a specific example. Tara Car Holdings surged 21% after it was revealed that the activist Investor Value Act Capital had acquired a stake. That's a clear signal that foreign money is still actively seeking out opportunities in Japanese companies. Furthermore, Japanese companies themselves are helping. They're enhancing shareholder returns through increased dividends and share buybacks, which is helping to prevent any really extreme market deterioration and maintain investor interest. The focus seems to remain on liquid, high-momentum stocks within the Japanese market.
That sounds quite bullish for the medium term then, supported by foreign flows and corporate actions. But surely there must be significant headwinds that could derail this optimism. What are the big risks that could stop the Nikkei from reaching 48,000 yen?
Oh, absolutely. There are indeed significant headwinds that can make the path to 48,000 yen quite bumpy, if not impossible. Katsuhiko Nakamura over at Mizuho Securities points out that the diverging monetary policies between the U.S. and Japan could become a major headwind.
The Fed cutting while the BOJ hikes, potentially.
Exactly. If the U.S. Federal Reserve moves towards interest rate cuts, while the Bank of Japan, perhaps pressured by inflation, considers rate hikes, it could lead to significant yen appreciation. Many Japanese exporting companies have based their earnings forecasts on an assumed exchange rate of around 145 yen to the dollar. So a stronger yen, say, appreciating to 140 or even 135 yen per dollar, could significantly dampen their corporate earnings, especially for the big exporters that drive the Nikkei.
Right, a stronger yen hurts exporters' profits when converted back.
Precisely. Also, the potential for U.S. semiconductor tariffs still looms as a risk factor. On the downside, Nakamura suggests that the 38,000 yen level on the Nikkei could act as a strong support zone. That's based on the 200-day moving average and historical trading volume concentration, indicating a potential floor if a deeper correction were to occur. The Nikkei really is a great case study right now for understanding this complex interplay of global macro factors, corporate fundamentals within Japan, and shifting investor sentiment. It really highlights the need for investors to navigate the short-term noise while keeping an eye on that longer-term potential and the risks involved.
Okay, let's hop over to the U.S. then. It sounds like it was a tougher day for stocks there. We talked about Walmart's earnings disappointment being a big factor, but what else weighed on the market? Particularly the tech sector, which seems to have been struggling for a few days now.
You're right. It was definitely a challenging day for U.S. markets overall, and Walmart's sharp decline was certainly a significant drag, no question. The Dow Jones Industrial Average fell for the first time in 3 days. It was down 152.81 points, or about 0.34%. And as you noted, this was largely due to Walmart's performance, but there was also a clear ripple effect on other consumer-focused stocks like Home Depot and Walt Disney. It seems investors broadly reevaluated the consumer spending landscape after Walmart's cautionary notes on tariffs.
So it wasn't just Walmart in isolation, but maybe the whole consumer sector taking a bit of a hit, indicating broader caution about spending. What about the tech-heavy NASDAQ? It seems like that index has been particularly sensitive to all the talk about interest rates and Fed policy recently.
The tech sector definitely faced significant pressure, precisely because of its sensitivity to interest rate expectations and overall market sentiment. The NASDAQ Composite Index fell for the third consecutive day. It was down 0.34%, and the S&P 500 actually fell for the fifth straight day, down 0.40%. That marked its first 5-day losing streak in about 8 months.
5 days straight for the S&P 500, that's a noticeable losing streak.
It is. And tech stocks, particularly as perceived as being maybe overvalued after their big runs, especially amid all this uncertainty about Federal Reserve policy. Companies like Meta Platforms, AMD, Advanced Micro Devices, they face significant selling pressure. It seems investors are reevaluating their risk appetite for these high-growth, high-valuation stocks when the future cost of money, interest rates, is so uncertain.
That makes sense. Risk-off sentiment hitting the highest flyers. But with such a broad-based decline across the major indices, did it feel like deeper market panic setting in? Or is it something else maybe related to everyone waiting for that Jackson Hole speech?
That's a crucial distinction to make. Interestingly, despite the declines, analysts noted that the bottom of the U.S. stock market remained firm.
Meaning it didn't feel like a free fall.
Exactly. It indicated more of a cautious wait-and-see attitude rather than widespread panic selling. It suggests investors were primarily trimming risk, maybe taking some profits, and just awaiting clarity from Fed Chair Powell's speech at Jackson Hole, rather than dumping assets in a frantic rush. They really want to see the direction of monetary policy before making big commitments.
So cautious selling, not panic selling.
Seems that way. And on the flip side, it wasn't all red. Some stocks, like Merck in healthcare, Chevron in energy, and United Health Group, also in healthcare, actually rose. This shows some sector-specific strength and perhaps a rotation into more defensive or value-oriented areas. Capital's still seeking returns, it's just maybe shifting where it's looking. But overall, the day really highlights how a single major company's earnings, like Walmart's, combined with broader sector concerns, like tech valuation worries, can influence the entire market mood, especially when investors are already on edge waiting for key economic signals like Powell's speech.
Okay, so if the U.S. market was down and Japan was mixed after its big run, what was happening in other major markets around the world, like in Europe or India? It sounds like a very fragmented global picture, not like a single tide lifting or lowering all boats.
It truly is a mixed picture today, and that really demonstrates that the global market is rarely monolithic. Local economic data, specific policy expectations, regional sentiment, they can all create very different outcomes, even on the same day. London, for example, actually had a very strong day, bucking the trend we saw in the U.S.
London was up, while the U.S. was down.
Yes. The UK's FTSE 100 index rose for the fourth consecutive day, and it actually closed at a record high of 9,309.20. It was up 9.22% on the day. This reflects a really impressive 14% gain for the FTSE since late 2024.
A record high for London. What was driving that strength, particularly when other major markets were pulling back ahead of Jackson Hole?
It seems to be driven primarily by easing concerns about the UK economy specifically. Recent positive PMI data, better than expected, and figures showing lower than expected public borrowing. These factors seem to have reduced fiscal concerns and boosted investor confidence in the UK outlook. Certain sectors performed particularly well. Aviation stocks like Rolls-Royce, defense contractors, resource companies benefiting from commodity prices, and banking stocks like NatWest.
So, strong domestic factors outweighing the global caution.
It appears so, at least for London today. However, it wasn't universally positive even within the FTSE. Real estate and software shares did decline, perhaps reflecting those lingering concerns about higher interest rates impacting those specific, more rate-sensitive sectors.
Got it. And what about the Eurozone's major markets like Germany and France? They're often seen as bellwethers for the broader European economic health. How did they fare?
Germany's DAX index ended the day largely flat. It was up just 0.06%. It seems a prevailing wait-and-see attitude dominated there ahead of Jackson Hole, much like we saw in the U.S. towards the end of their trading day. Within the DAX, defense and bank stocks gained, perhaps on eased U.S.-EU trade uncertainty whispers, but materials and consumer stocks like BASF declined, indicating maybe a bit of sector rotation there as well. France's CAC 40 index, on the other hand, fell 0.43%, so really a mixed to slightly negative picture across the Eurozone's major indices today.
Okay, mixed in Europe. And what about India? That's a rapidly growing economy, often seen as a significant emerging market opportunity. How did their market perform?
Indian stocks actually extended their gains for the sixth consecutive day. The Sensex index was up 0.17% to close at 82,000.71.
6 days of gains. What's boosting confidence there?
A composite PMI reading surged to 65.2, which is a very strong number, boosting confidence in private sector expansion and underlying economic growth. However, caution ahead of Jackson Hole is also limiting aggressive buying there, so they aren't seeing explosive growth, more of a steady climb recently. Profit-taking is expected by analysts, although hopes for a potential goods and services tax, GST reduction in October, might be offering some underlying support, potentially boosting future consumer spending. So overall, the Sensex is expected to trade relatively flat near this 82,000 level in the near term.
It really showcases the divergent performance then.
Exactly. It shows how these different global markets operate, local economic data, specific policy expectations in India, UK fiscal health. They can create very different outcomes even on the same trading day. There's truly no single global market tide right now.
Before we move on to sort of bigger picture future trends, were there any other specific company movers and shakers in Japan today that maybe illustrate some of these broader themes we've discussed, like currency impact or sector weakness?
Yes, absolutely. A few stand out as really great micro examples of these larger macro trends playing out. Toyota, for instance. The auto giant rose in morning trading in Tokyo, initially buoyed by the yen's weakness, which fell into the low 148 yen range against the dollar.
Right. Weaker yen helps exporters like Toyota.
Exactly. It often directly boosts their export profit expectations, especially since Toyota's own assumed exchange rate for its current fiscal year, FY 2026, is a much stronger 145 yen to the dollar.
Yeah.
So a weaker yen is pure upside to their forecasts. However, Toyota's gain stalled later in the day. Why? Amid broader concerns about U.S. auto sales potentially slowing and also absorbing those cautious comments coming out of the Jackson Hole Conference regarding Fed policy. It really shows that dual impact currency helping, but broader economic sentiment may be hurting.
A push and pull. Interesting. What else?
Then we have Asahi Kasei, a major chemical company. Their stock actually fell 1.48% today. This was despite news that they're making a significant $16 billion investment to double their production capacity for a key semiconductor insulation material by 2030. This is a move specifically aimed at supplying major customers like TSMC.
That sounds like fantastic long-term strategic news for them, investing in the booming semiconductor supply chain. Why would the stock fall on that news?
It seems profit-taking prevailed. The stock had recently hit its year-to-date highs, so some investors likely decided to cash in. Plus, it was also impacted by just overall weakness in the broader chemical sector today. It just illustrates how sometimes even very positive, long-term strategic news can be overshadowed in the short term by market dynamics, like profit-taking or sector-specific headwinds.
Market timing and sector trends matter. Got it. One more.
Finally, SBI Holdings, the financial services group, they continued their recent rise, climbing another 2.94% today to 6,747 yen. This came after they officially announced a capital alliance with Tohoku Bank, where SBI will acquire a 2.95% stake. This move expands SBI's ambitious fourth megabank strategy, where they're building alliances with regional banks across Japan. This brings their total number of regional bank alliances up to 10 now. So this is seen by the market as a very positive development for SBI's medium to long-term business expansion and strategy execution. It showcases the company strategically consolidating its market position in the financial sector through these partnerships, and the market is rewarding that clarity of vision.
Okay, let's shift gears a bit. This next piece of news is something we don't often talk about on a daily basis, but it feels really important for how companies are actually run and how shareholder value is hopefully protected. It's about the compensation for external directors, the independent people on company boards. It's apparently hitting record highs in Japan. Why is that happening? Are they suddenly doing a lot more work? Or is it a sign of something else changing in Japanese corporate governance?
That's an excellent question, and it points to some really significant and arguably positive shifts happening in corporate governance within Japan. They seem to be moving closer to global standards in this area. The average compensation for external directors at major Japanese-listed companies reached a record 17.9 million yen in fiscal year 2024.
17.9 million yen. How much is that in dollars, roughly?
Roughly around 120,000 US dollars, give or take, depending on the exchange rate. And importantly, that's up a notable 25% from just 5 years ago.
A 25% increase in 5 years is pretty substantial. You mentioned their responsibilities are expanding. What exactly are these external directors now expected to do that's different from before? What makes them worth so much more now?
Their responsibilities really are expanding significantly beyond just the traditional advisory or monitoring roles they might have played in the past. External directors in Japan are now increasingly expected to be crucial dialogue facilitators. They need to bridge the gap between internal management and external stakeholders. That means shareholders, regulators, the broader public. They're also increasingly being called upon to lead special independent committees. These committees evaluate complex M&A proposals, like hostile takeover bids or management buyouts and BOs, to ensure fairness and transparency, particularly for the general minority shareholders.
Okay, so more active roles in strategy and fairness.
Exactly.
Yeah. Critically, they exercise significant oversight responsibilities in cases of corporate misconduct. They act as that vital independent check on management power. These expanding roles simply demand a much higher level of expertise, a bigger time commitment, and frankly, greater personal accountability, all of which justifies the increased compensation levels we're seeing.
So it's really about paying for more direct involvement, more responsibility, and crucially, further independence from management. Are companies also changing how they pay them? Like linking their pay more to the company's performance to align their interests better with shareholders?
Yes, that's another key trend that really underscores this changing role and the desire for better alignment. More companies, including big names like NEC, are introducing stock-based compensation for their external directors. This now accounts for about 14% of Japanese companies, which is up 2 percentage points just from last year.
So giving them skin in the game.
Precisely. It's a deliberate strategy to align the external director's financial interests directly with creating long-term corporate value and benefiting shareholders. It encourages that medium to long-term perspective. Now, while Japan's median compensation, that 17.9 million yen, is still less than half of the typical level in the U.S., which is around 49.2 million yen, or over $300,000 U.S.
Big difference.
Huge difference. But Japan has now surpassed the average compensation level seen in France. This indicates Japan is rapidly catching up in how much it values this critical independent oversight role. They're recognizing its importance.
It sounds like there must be a growing demand for really high-caliber external directors then. Could that be leading to a bit of a talent crunch, especially if companies are also trying to increase diversity on their boards, gender, nationality, different backgrounds? Is that also pushing pay higher?
Exactly. That's another major factor driving this trend. The push for board diversity, whether it's gender, nationality, or different professional expertise, is definitely intensifying competition for top-tier directorial talent. Japan, for instance, is still behind its own government-set targets for female directors on boards. They're only at about 16% currently compared to a stated goal of 30% by 2030.
So they need to find a lot more women directors.
They do. And this shortage often leads companies to look externally, sometimes internationally, and that in turn drives up compensation, especially for foreign directors or those with specific sought-after experience. For example, the report mentioned Michael Oschinger, an external director at Takeda Pharmaceutical, saw a 15% increase in compensation, reaching 53 million yen. That reflects this intense competition for top-tier international talent willing to serve on Japanese boards.
Wow, 53 million yen. That's serious money.
It is. And as these roles continue to expand and become more demanding, it's very likely that more Japanese companies will adopt these more Western-style external director systems and compensation structures. That could potentially drive compensation even higher in the coming years. This whole area, often overlooked, is just a crucial aspect of corporate governance. It directly impacts how well a company is managed, how accountable management is, and ultimately, how shareholder value is protected. It's all about ensuring robust checks and balances are in place.
Okay, shifting gears again back towards policy and politics. We mentioned former President Trump's tariffs earlier and their impact on Walmart, but it seems his influence or potential influence is popping up in other financial areas too. I read something about him personally buying a lot of bonds and even having strong opinions on who should be serving on the Federal Reserve Board. This sounds like it could raise some eyebrows, maybe even concerns in financial circles.
You're touching on some very significant areas where political figures, especially those in positions of immense power or actively seeking it, can potentially exert influence on financial markets and institutions. And yes, sometimes in ways that raise legitimate concerns about transparency, potential conflicts of interest, and institutional independence. It's a complex picture. Regarding the bonds, yes, reports indicate that former President Trump has personally purchased over $100 million worth of corporate and municipal bonds. This involved more than 600 individual transactions since his inauguration back in January.
Over $100 million in bonds. That sounds like a substantial personal investment portfolio. Could there be any potential conflicts of interest there, even if indirect, when someone in such a powerful position or seeking it again holds so much in corporate debt?
That's precisely the concern that has been raised by ethics watchdogs and some commentators. These bond purchases reportedly include debt issued by companies like Citigroup, Meta Platforms, Facebook's parent, and Home Depot. These are companies that could potentially benefit or be harmed by policies enacted by his administration should he return to office.
Right. Policies on regulation, taxes, trade.
Exactly. Now, his assets are reportedly held in a trust operated by his children, a structure designed, in theory, to separate his personal finances from his official duties. However, the revenues generated by these holdings still ultimately contribute to his overall assets and net worth. So this structure, while common, still invites questions about potential conflicts, even if they are indirect, simply because the ultimate beneficiary is clear.
Okay. And then there's the Federal Reserve issue. The independence of the Fed from political interference is usually seen as absolutely sacred, almost foundational for financial markets globally, isn't it? What's going on with his reported opinions on specific Fed members and actions being taken regarding them?
This is a particularly sensitive area, you're right, as the Fed's independence is indeed foundational for market confidence, both domestically and internationally. What happened recently is that the U.S. Department of Justice, the DOJ, sent a letter to Fed Chair Powell, urging the resignation of Fed Governor Lisa Cook. This was related to mortgage fraud allegations dating back some years.
The DOJ urged her resignation. That seems unusual.
It is unusual, and adding complexity, this move was reportedly prompted by the director of the Federal Housing Finance Agency, Kevin Parrott, who is known to be close to former President Trump. Furthermore, Trump himself had previously, very publicly, demanded Governor Cook's resignation via social media posts.
So he's publicly calling for a sitting Fed governor to resign.
Yes, which is highly unconventional for a former or current political leader to directly comment on, let alone demand changes in, the composition of the independent central bank board.
So he seems to be actively trying to influence who sits on the Fed, even urging resignations. What are the broader implications of something like that for market stability and maybe even for the U.S. dollar standing in the world?
The potential implications are significant and quite far-reaching. This kind of action raises serious concerns about maintaining the independence of the Federal Reserve from overt political interference. Now, legally, only the president can formally remove an approved Fed governor, and then only for just cause, which is a high bar. However, Trump's actions, from his social media pronouncements to the reported discussions of dismissal and the DOJ letter, create immense uncertainty and market apprehension. Some analysts, like Carol Kong over at Commonwealth Bank of Australia, have explicitly suggested that such actions could undermine confidence in the dollar as a safe asset.
Undermine confidence in the dollar itself. Wow.
Yes, because the perception of the Fed's political independence is absolutely crucial, not just for U.S. economic stability, but for global financial stability, given the dollar's role as the world's primary reserve currency. It really demonstrates the tangible ways political figures can directly influence financial markets and institutions, from their personal investments, potentially creating conflicts, to their efforts to shape the very bodies, like the Fed, that are designed to be independent and politically neutral. It's a space to watch closely.
Okay, finally, let's try and broaden our view a bit, look beyond the immediate market moves and the policy battles. What are some of the interesting new ventures or technological developments we're seeing, especially in those really cutting-edge areas like autonomous tech or new forms of energy?
Right.
These are the innovations that might really shape our long-term future, aren't they?
It's always good to lift our eyes to the horizon, absolutely. And there are indeed some truly innovative ventures pushing the boundaries right now. In the new energy space, for example, we're seeing significant advancements from a company called Oklo. They're focused on next-generation nuclear power. Their stocks saw a nice rise recently after they signed a Memorandum of Understanding, an MOU, with the Swiss electrical engineering giant ABB.
Oklo, they do those small modular reactors, right? The SMRs, which are already seen as potentially safer and more flexible than the huge traditional nuclear plants. What makes this specific partnership with ABB particularly noteworthy beyond just using ABB's technology? What's the big breakthrough potential here?
What's truly groundbreaking in this partnership is their plan to use ABB's electrification and automation tech to set up a control room for remote operation of Oklo's Aurora powerhouse, commercial SMR.
Remote operation of a nuclear reactor.
Exactly. This could potentially eliminate the need for 247 on-site operating staff, which would be a significant step forward in terms of both safety protocols, reducing human presence, and operational efficiency for nuclear power. It could dramatically reduce operating costs.
That sounds like a game changer for nuclear economics.
Could be. Their first plant, planned for Idaho, is slated for operation sometime in late 2027 or early 2028. This partnership really showcases how technology is pushing the boundaries of what's possible, even in established industries like energy production, making advanced nuclear power potentially more economically viable and scalable than ever before.
That's a huge potential step for the nuclear industry, making it possibly more attractive financially. And on the autonomous tech front, any further updates on Baidu's efforts? We touched on their ambition to expand their autonomous taxi business globally earlier.
Yes, Building directly on our earlier discussion about Baidu's strategic pivot towards AI, their CFO, He, specifically highlighted the acceleration of the global expansion plans for their autonomous taxi business, which they call Apollo Go. This renewed commitment, stating they're speeding things up, indicates a really strong belief not just in the future viability of self-driving technology, but in their own ambition to be a major global player in that rapidly developing space, moving well beyond just their domestic Chinese market.
So it's not just a side project for them, it's a core growth pillar they're pushing hard.
It certainly seems that way. These kinds of stories, whether it's Oklo and nuclear energy or Baidu and autonomous transport, offer a really fascinating glimpse into the long-term innovations that are actively shaping our future economy right now. They highlight how strategic partnerships like Oklo and ABB and cutting-edge technology are continuously pushing the boundaries of what we previously thought was possible, potentially creating entirely new industries and, of course, new investment opportunities along the way. So wrapping up, today we've really navigated a truly dynamic financial landscape, haven't we? We've gone from the intricacies of corporate brand image at McDonald's and profit pressures at Walmart due to tariffs, all the way to the sweeping influence of central bank policies, Jackson Hole anticipation, and those geopolitical currents shaping global markets, like with NVIDIA. We've seen how AI is fundamentally redefining tech giants like Baidu, how corporate governance is evolving for the better in places like Japan, and how seemingly disparate news items, tariffs, bond yields, tech chips, Happy Meals are all actually interconnected, forming a single, complex financial story. Thank you for joining us on this deep dive into the latest financial headlines. Until next time, stay informed and stay curious. And as we head into the weekend, perhaps awaiting those critical signals from Jackson Hole, here's something to consider. If global fiscal policies, government spending, and tax plans are indeed a key driver behind the steepening yield curve we discussed, suggesting not just increased government borrowing, but also maybe a potential fundamental boost to the economy and future inflation, how might this truly reprice risk and opportunity across every investment you consider? How might it change the game, perhaps far beyond what traditional interest rate cut cycles, which we focus on so much, have taught us? What new opportunities might emerge, and what old risks might shift in a world where governments might be actively stimulating growth right alongside central banks trying to manage inflation? Something to ponder.